ESG is just the world's impact on a company, whereas sustainability is a company's impact on the world. And so what I mean by that is that ESG is really just around what are those factors in the world in those E, S, and G pillars? How do they impact a company's finances? That's it. It's nothing else. It's nothing groundbreakingly new or even that complex. But, that is different to sustainability because that goes from looking at what is the world's impact to a company as to how does that company impact society and the environment around it.
Welcome to The Greener Way. I'm your host, Michelle Baltazar, Director of Media at FS Sustainability. We are recording on Gadigal land and we pay our respects to the traditional custodians of country and elders, past, present, and emerging. Today's guest, Dug Higgins, is the head of responsible investment and real assets for the broader Zenith Group. He is also the sector head for real assets, with 24 years of experience in private market real estate, infrastructure, and natural capital. Dug, thanks for joining us.
Thanks for having us, Michelle.
So the question we want to answer by the end of this episode is how do financial advisors and their investor clients benefit from a fresh discussion on product labeling as they relate to ESG and sustainability? We are also going to talk about greenwashing and the solutions moving forward. So Dug, first off, you're a familiar name in the investment research scene, having joined Zenith back in 2009. And you would have had conversations about ESG under a different name. Tell us a little bit more about your background.
Yeah, look, I guess as you'd alluded to, I've had that sort of, 20 plus years in fund research and, that's been across all asset classes and, public markets and private markets. And I think, for us and where I work now, but for me personally, that's sort of a really long time of working with advisors and helping them help their clients has been really rewarding. Particularly over, I guess, the last 7 or 8 years, it's had increasing involvement in looking at ESG and sustainability. And so now I look at that kind of across everything we do. It's across ratings, it's across investment management and our own corporate sustainability activities. But I think ironically, if you kind of went back to when I started in this industry back in 2001, I actually built a responsible fund rating model back then, when
wow.
SRI and triple bottom line accounting was a real buzzword. So I seem to have come full circle.
You were blazing the trail. I remember when I first started as a journalist in financial services, certainly there was a lot of discussion then about responsible investing. SRI was one of the buzzwords, but clearly this is nothing new. And I feel like we're just going through the next phase now, which is when we fine tune how do we articulate what sustainability is and what ESG is. Now, you wrote about this. So you wrote about labeling and that the two aren't the same. Can you elaborate? And is it because you're getting these kind of queries from advisors? Like you said, you've worked with advisors for more than 2 decades now, at least. Is that the genesis of this conversation around ESG, sustainability, and correct product labeling?
Yeah, I think certainly part of it is advisor queries. And we get the queries because the terminology is so loose, which is a problem. And so we're obviously trying to help them so that they can understand what they're looking at in a fund. But I think also it's a market gatekeeping function. I mean, we are gatekeepers in assessing funds. And so where I see managers making loose claims, I challenge them. We feel that that's part of our role. And if that doesn't stand up to the sort of questioning that we give, well, that might affect how we look at their ratings or even to the point where, we might think that they're unrateable. But coming back to the question about, well, why is this particularly a problem when people talk about ESG and sustainability? I think it's that aspect of trying to get people to understand that, these can be two very separate things. And what we're trying to get people to think about is that from a purist perspective, ESG is just the world's impact on a company, whereas sustainability is a company's impact on the world. And so what I mean by that is that ESG is really just around what are those factors in the world in those E, S, and G pillars? How do they impact a company's finances? That's it. It's nothing else. It's nothing groundbreakingly new or even that complex. But, that is different to sustainability because that goes from looking at what is the world's impact to a company as to how does that company impact society and the environment around it. And so it's an issue when you confuse the two of them because there are no common definitions. So one of the ways that we like to think about it is that, it's kind of all sustainable funds think about ESG, but not all sustainable funds will think about it the same way. And so what we need to remember is that, like, let's face it, most fund managers don't want to save the world, but they do want to use ESG to make better investment decisions. The question is that all that's on the table? Are they thinking past ESG, using that as a springboard to also think about what are the sustainability aspects a fund might trying to be target?
You are the first person to talk about ESG and sustainability to me in that way, about what's impacting the company versus the company's impact on the world. And in many ways, I see that if you do talk about ESG as metrics that you have to react to or respond to as a company, then that becomes a financial risk, right? So there's an alignment there, rather than saying, oh, we want to be a good company, therefore we're going to abide by these rules. You're actually saying we want to be a successful company, therefore we are going to look at these factors that will impact us in the future. But then with sustainability as well, it has become an umbrella term. Can you kind of just explain what does that mean? Because we are using these terms interchangeably at the moment, and you're the first to really kind of articulate the difference between the two.
Yeah, I don't know that I'm the first, but maybe I'm just trying to do it as simply as possible because I'm a simple guy. But I think one of the other ways to think about it is there's this concept called single versus double materiality. And some of the jurisdictions are starting to use this a little bit more than others. But what that essentially means is that single materiality is just looking at that ESG, the world's impact on financials. Single materiality is all about what is the impact on financials. Double materiality is that, and how does a company affect the world around it? So it's very similar to that ESG versus sustainability aspect. The reason it's important, single versus double materiality, is how a lot of these global standards are getting anchored. And so if we look at Australia, the UK and the US, so a lot of the new rules that they are putting forward, say, for example, Australia's new ASRS mandatory climate reporting, that is anchored on single materiality. What are climate's effects on the finances of a company, and is it material? Europe, however, given their long sort of standing history of going a bit further, a bit faster, they are using double materiality in anchoring their new frameworks. And so companies there are having to report both on the financial materiality of impacts, but also on the impacts of those companies on the world and society around them. And so, this starts to become important. It's not just a theoretical about, which way does the circle run. This is starting to get embedded in legislation around the world. And so therefore, companies, boards, fund managers, they need to be across this stuff.
So this whole thing about single versus double, or single and double, what are the conversations you're having with financial advisors right now that they can relate to or they can talk to their clients about? Is that still the single materiality or the double materiality, or both?
Yeah, I think the conversations that we're having with clients is really actually more fundamental in that we're just trying to get them to understand that the two things exist and what are the problems that you can get into if you confuse them, if you're trying to, conflate them together. And so, this is a really common one. You take, the XYZ Global ESG Fund. Now, most people would think that, that might be about holding companies that do good or that are sustainable. But if you look under the hood, you can get this classic case of, the ESG fund, it owns McDonald's, Aristocrat, Woodside, British Tobacco, and RTX Corp, which is a weapons company, effectively. And so people would look at that and go, hang on a minute, surely this is greenwashing. It's not, because if we think back to about that definition of ESG, this is about financial materiality. So all of these companies have high ESG ratings from one of the major ratings providers, but it's because those ESG methodologies are typically focusing on what is the exposure and resilience to long-term financially relevant ESG risks that company faces. It's not about whether or not they're undertaking controversial activities. And so this is why that separation between sort of single materiality and double materiality is really important, because, it comes back to what we were saying before about most managers think about ESG in their decision-making process. It doesn't mean they're trying to save the world. So this is where the whole concept of labeling starts to become important. You've got to separate these two things and understand that they have a relationship, but they're not interchangeable. Because if you think they're interchangeable, then you get yourself into some very awkward positions.
You get yourself into a bind, and certainly there was a news story early last year about an investor who thought, oh, this is a green fund, and then found out that this green fund had a gambling stock, for example, there, but not really understanding. Well, of all the gambling companies, this was the best of breed, or this had really good ESG ratings. So, in terms of practical terms, I'm a financial advisor. I don't really care about the definitions. All I want to do is make sure I serve my client and I offer these fund manager options that are aligned with their values. Is that possible?
Look, it's possible, but it's difficult. I think we have to accept that perfect is the aim, but embracing imperfection is the reality. And the reason I say that is that particularly once you start to get into sort of values-based investing, where people have a view on, okay, I don't want my capital to go towards certain industries or activities, there are limits to a certain extent to which you can do that. And one of the really classic cases is thinking about the value chain. And you think about something as simple as weapons, for example. And so we saw a lot of this, obviously, with more and more conflicts around the world in the last few years. And we get people coming to us and say, okay, I want all weapons exposures out of the portfolio. And you look at it and say, okay, let's unpick that and try and work out where you want to get a level of happiness. Because where do you draw the line? Is it the sellers of the weapons? Is it the makers? Is it the people who transport them? Is it the people who dig the materials up out of the ground to make them? Is it the designers? Where do you draw the line? I mean, let's face it, the US is the world's largest suppliers of weapons. It's like 70+% of the weapons market. Do you want to take the US out of all your stock and bond portfolios because you take that view? All of a sudden, your portfolio is going to end up looking pretty interesting. So what we're trying to get people to understand is, where are you happy to try and balance, the values versus pragmatism? And you can go right down to the narrow end of pragmatism and say, I just want it all out. I'm willing to, not invest in the US because of the role it plays in the weapons trades. Well, they're about probably 60 odd % of both the equity and the bond market. You're making some pretty big concessions there. So it's not about saying that you shouldn't, but understanding the implications of some of these roads that you go down.
Yeah, so it is possible, incredibly difficult, but how big is the investment universe? Do you see that there's a reasonable number of, let's say, ESG funds out there that could meet the very personal or individual requirements of, say, a financial advisor's client base?
Yeah, I think, and just so we're clear, we wouldn't say ESG funds because about 70% of every fund out there is using ESG as a tool. So let's think more about the ones that are going down that sustainability thematic. They're using both ESG and sustainability and also ethical screening because that's part of it. So at the moment, right now, based on the funds that we're aware of, we'd say there's probably about 110, 120, responsible funds out there that are using a combination of ESG, sustainability and screening. And these are across the asset classes. There's lots of opportunities in Australian and global equities, quite a few in Australian and global fixed income. Some of the other parts of people's portfolios start to get a bit narrower in areas like real estate and infrastructure. But then conversely, like those areas are actually very aware of sustainability issues because they're often quite carbon heavy. So they may not overtly look like they're moving towards sustainability, but because they're asset owners, there's actually a lot already going on under the hood. So I think there are a lot of funds out there. You do get swings in appetite. We're kind of in a scenario at the moment where a lot of these funds have actually been kind of going dormant or even withdrawing from the market just because they found that the hype cycle is in that sort of sliding into the trough. And so they're saying, well, maybe we'll come back later. But, the hype cycles swing backwards and forwards. I suspect that in the next sort of year or two, the focus is actually going to start to come back on sustainability investing because we now have mandatory climate reporting. We're going to have a very large swathe of the economy now doing mandatory reporting on carbon emissions and other issues. That's going to start to draw attention back, I think. So, advisors, I think, should be aware that there are options out there. They may not always be the precise option that suits a particular client. And this is where coming back to that, what is the balance that the client, what would the client prefer where relative to what they would accept, needs to be that thing that needs to be unpicked between the advisor and the client so that everyone's happy.
Now, you mentioned greenwashing earlier, and ASIC has been very vocal about saying this is a priority for us. But in a recent op-ed that you wrote, you said, well, is it really greenwashing? There's a lot of confusion. You mentioned that maybe it's unclear disclosure, for example. So what's your view on greenwashing in general and the kind of developments in this space?
Yeah, it's an interesting one. I think we need to recognise that if we look across the various litigations and infringement penalties, not all of them have actually been around, fund managers trying to deliberately hide what they're doing. A lot of it has actually just been around accidental mismatch of disclosures and disclosures that perhaps weren't quite clear enough. Sometimes it's actually the separation between what the legal team say and they'll spell it out very clearly, but then what does the sales and marketing team say when they're trying to translate that into something that people understand easily? And you get this mistranslation and the regulator doesn't like that. So that's part of it. But I think, why is this a problem? Well, if you're an advisor and you've got a client who gets put into a fund and they get exposure to something that they didn't expect, that obviously conflicts with their values, because this is a values-based decision usually from an investor. They say, I want to put money into here because I don't want exposure to X, Y, and Z. So if they do find out they have exposure, they're going to justifiably be pretty indignant about it. Then the advisor gets blowback and risks losing the client. And so, and the government themselves may find that if this persists, the whole industry starts to lose capital coming in and effectively defunds companies that are looking to move beyond just the traditional metrics of looking at financial materiality. And, necessary capital to support the transition through the private market, it starts to dry up. We don't need that. So, we know that confusion creates uncertainty and the markets hate uncertainty. And so this is why we need a better system of labeling to at least try to get to a base standard of understanding how we describe these things and how that they work in the real world.
And are we there yet in terms of the product labeling? We've been talking about this for the past 3-4 years. Associations talk about, is it ESG or is it sustainability? Are fund managers understanding, well, how can we address this so that we no longer create that uncertainty that would dry up the inflow of funds?
Yeah, it is still absolutely the Wild West. There's still embarrassingly little agreement out there on this. I think if fund managers are operating in global jurisdictions where some of these rules are already in place, it gets a bit better. But yeah, we definitely need a better system than what we've got. And I think we need to realise also that there is no magic bullet to this. Like a lot of people say, oh, we'll come up with this framework and it'll solve greenwashing. Well, to be frank, we've had rules on misleading and deceptive conduct for 50 years. And, that is not stopping people doing things in the incorrect way if they feel like it. So, we need consensus on terminology, but we also need it to be flexible enough to operate in fast-changing environments. What we've found in some of these jurisdictions that have already brought this in, whether it's disclosure-based rules like we have in Europe or fund labelling rules like we have in the UK, there's still a lot of inflexibility and mismatching going on in that, I think. And so we definitely should be looking at the offshore examples to find out, firstly, what hasn't worked, maybe even before what has worked, and try and use those offshore experiences to not go over old ground and old problems here when we design this. The regulators need to listen to the market and what their views are. But, and fund managers need to think about the clarity of their disclosures, because one of the biggest problems we seem to find is that everybody thinks more disclosure is better. But some of the problems that we've seen is that runs afoul of the the reasonable person test. This is how the government looks at it, or how the courts look at a lot of this stuff. Is the disclosure simple enough for a reasonable person to understand? Like, that really needs to be fundamental in how the whole market looks at this. And also it needs to be education. And we know that advisors are not going to be comfortable talking to clients on a topic that they don't feel they have the expertise. And why would they? So that's why groups like us are working with advisors to try and bridge that gap so that they have the confidence to work with clients to be able to advance this for everybody.
This has been fantastic. Anything else you'd like to share with our listeners?
Look, I think all I'd finish up with is say, this is a complex space and there are no perfect solutions. Investors need to be able to try and understand where that balance is between what they'd like to have and what's possible. I think, learn to embrace compromise is really important, because the reality is that not everything that is green is good and not everything that's good is sustainable.
Well said. Doug, thanks again for joining us.
Thanks, Michelle. It's been a pleasure.
This is The Greener Way. I'm your host, Michelle Baltazar. Thank you for listening.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.